Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Trio Petroleum.
If you find our talks useful, please consider subscribe, like, and comment underneath. We have an absolute wild setup to look at today. Leading money daily.
And yet holding nearly $500 million in reserves.
Exactly. And they just saw a 138% pre-market price surge on March 2nd, 2026. So for you listening, we're going to bypass all that surface level noise today. We really want to understand the high stakes, real-time mechanics of the specific market move.
Right, because the juxtaposition in the data here is just, it's jarring. But that's honestly what makes it such an incredible case study in wealth building mechanics.
Yeah, you have quantitative metrics that basically scream distressed asset, but then they're sitting right alongside a 7 out of 10 bullish sentiment score from institutional analysts.
It's fascinating. I mean, the market is trying to price an entity that is simultaneously standing on the edge of a liquidity cliff and, sort of strapping on a jetpack of massive asset valuation at the exact same time.
That jetpack being a $475 million moat. But before we get to those massive reserve numbers, let's look at the thrust keeping them airborne right now, the fundamental revenue story.
Let's do it.
So looking at their fiscal year 2025, Trio Petroleum reported revenue of $398,734.
Right.
And, I mean, let's be honest, in absolute terms, in the energy sector, that is a rounding error. There are local restaurants making more than that.
Absolutely. But absolute dollars are a trap here. You can't look at it that way.
Why is that?
Because the critical metric is the trajectory. That revenue figure, as tiny as it is, represents an 87% increase from the prior year.
An 87.02% increase, to be exact.
Right. And trajectory is literally the only thing that matters in the microcap space during a scaling phase. That 87% jump isn't some weird accounting anomaly. It's the physical manifestation of a company crossing probably the most dangerous chasm in the resource sector.
The valley of death.
Exactly. They are transitioning from purely exploring and acquiring land, which is just lighting money on fire, to actually pulling heavy oil out of the ground and selling it. That transition is called the valley of death for a reason. You have to spend like a major producer before you can earn like one.
And you can see that valley of death perfectly reflected in their margins right now. They are making a 55.9% gross margin.
Which is actually really solid.
Yeah. They are seeing a 55% profit on the actual physical process of pulling oil out of the ground. So the core extraction model works.
It definitely works.
The problem is the massive corporate overhead sitting on top of that early production. It's dragging their net margins down into the negative thousands, specifically a negative 1,826.3% net margin.
Yeah, that's the number that scares people away. To anyone who doesn't analyze early-stage industrials, a negative 4-digit margin looks like a reason to instantly short the stock.
I mean, it sounds like they're losing $18 for every dollar they make.
Basically, yes. But you have to conceptualize this like a tech startup. Imagine a startup that just built a $1 billion state-of-the-art server farm. And on day one, they sign up their first 10 subscribers.
Okay, right.
The cost of running that massive infrastructure compared to the revenue of just 10 users is going to yield a spectacularly negative margin. Trio Petroleum is carrying the full regulatory, legal, and structural weight of a publicly traded entity, but they are spreading those fixed costs over only the first initial trickle of barrel production.
That makes a lot of sense. A negative 1,800% net margin is terrifying if you don't look at the curve, but their overall loss is actually narrowed by about 24% down to negative $7.28 million.
Which leaves them with a diluted EPS of negative 80 cents.
Right. So that tells me the operational efficiencies are finally starting to kick in.
They are. The bleeding is slowing down.
Still, driving down the highway with the fuel light flashing is incredibly stressful for an investor. Based on the early 2026 data, Trio has about $882,000 in cash against a $2.6 million operating cash burn. That is roughly a 4-month runway before the bank accounts literally hit zero.
Yeah, and the distressed current ratio tells the exact same story. It sits at 0.58, meaning for every dollar of short-term debt, they only have 58 cents in liquid assets to cover it.
Which is not great.
Not great at all. But again, the anomaly we need to focus on is that this 0.58 ratio is actually up 164% year over year. The absolute number is dangerous, sure, but the velocity of improvement is striking.
Okay, but let's play devil's advocate here. A $475 million valuation in the ground means absolutely nothing if they run out of cash in 4 months before they can dig it up.
Right.
How do they actually cross that valley of death? Usually, a 4-month runway means an imminent, massive stock dilution to raise cash, which absolutely crushes the value for existing retail shareholders.
That is the standard playbook, yes. Which is exactly why the events of February 2026 are the linchpin of this entire bullish thesis.
Let's get into that. What happened in February?
So $1.2 million in convertible notes, this was debt originally issued back in August 2025, were fully retired. But crucially, they were not paid off in cash.
Because they didn't have the cash.
Exactly. The institutional investors holding that debt converted into common stock instead.
I want to pause on the psychology of that move for a second, because for you listening, this is a massive signal. If you are an institutional investor holding legal debt on a company that might go bankrupt in 4 months, you hold all the cards.
Every single one of them.
You can demand your cash, or you can force them into restructuring where you end up owning the hard assets anyway. Treating legally protected debt for shares of common equity at that specific moment of maximum financial stress is a profound choice.
It is the ultimate tell in the institutional poker game. These debt holders are looking at the exact same 4-month runway we are. By choosing equity over debt, they are executing what essentially amounts to cluster buying.
Right.
They are signaling to the broader market that the future upside of the equity far outweighs the immediate safety of the debt. Converting that paper instantly neutralizes the threat of dilution that the market was terrified of, and it fundamentally stabilizes the balance sheet overnight.
And the reason they want that equity so badly brings us to the moat we mentioned earlier. The updated 2024 estimates show Trio's proprietary reserves rose by $67 million. We are talking about a $475 million valuation based on discounted net cash flow.
At a 10% discount rate, yes.
Yeah.
The PV10.
Exactly. Think of PV10 as the energy industry's ultimate lie detector test. It forces companies to show what their undrilled oil is actually worth in today's dollars, after all the extraction costs and discounting for time at 10%. It completely strips away the marketing fluff.
It leaves you with the cold, hard, present value of the assets. And having nearly $500 million in proven PV10 value completely reframes this entire risk profile.
How so?
Suddenly, that $2.6 million operating cash burn doesn't look like a path to bankruptcy anymore. It looks like a very small toll fee to access a massive vault.
Wow, that's a great way to put it. And the location of that vault is just as important as the size. We are talking about onshore assets in North America, specifically the Monterey shale in California and newly acquired fields in Alberta, Canada.
Location is everything in this sector.
Right. For anyone managing risk in an energy portfolio, Trio provides a remarkably low-cost entry point into high-yield regions. Compare that to the major multinational conglomerates dealing with deepwater rigs, international shipping logistics, immense offshore environmental liabilities.
It's a completely different risk bracket. Trio has regulatory footholds onshore, fully shielded from those massive offshore operational risks.
And that geographic insulation is really the foundation of the massive market momentum we saw in early March. On March 2nd, the market abruptly woke up to this setup. The stock surged 138% in pre-market trading, breaking out to hit the key psychological resistance level of $1.
The $1 mark is a massive threshold for microcaps. It fundamentally changes how algorithmic trading systems view the asset. And practically speaking, it keeps the company compliant with major exchange listing requirements without having to execute a messy reverse split.
Right, which retail investors hate. So the stock shot up to $1 from a prior close of just 42 cents, and the day range actually pushed up between $1.03 and $1.36.
Which established a strong new support floor down around 82 cents. It effectively pushed the stock back into the middle of its 52-week historical trading range, which was roughly 35 cents to $2.29.
So the mechanics behind that specific violent move to the upside really rely on two distinct triggers, one micro and one macro. Let's start with the micro level. We have the Alberta catalyst.
Yes. Regulatory approvals finally cleared in late January 2026, and physical production officially commenced at their Alberta heavy oil site. This is an area designated NW 750-1W4.
The initial data expects this to add an estimated 30 to 40 barrels per day from 2 wells. And this was expected roughly a week to 10 days after February 5th.
Right.
Now again, 40 barrels a day isn't moving the needle for global supply, but for a company managing a tight operational cash burn, every single barrel of daily cash flow directly extends that 4-month runway.
Exactly. It proves to the institutional investors that the newly acquired Canadian assets are actually viable. And the context of Alberta is vital here. Alberta represents one of the most stable, well-regulated, and infrastructure-rich energy jurisdictions on the planet.
Heavy oil requires specific refining and transport capabilities, right?
Right, and Alberta has an entire ecosystem built around it. When Trio turns the valve on in Alberta, they aren't just proving they have oil, they're proving they have a frictionless path to market.
And then the macro trigger hit, turning that stable path to market into a highly sought-after premium. According to the market data from early 2026, unconfirmed rumors began circulating regarding supply disruptions in the Strait of Hormuz.
This is where things get really interesting.
Yeah. The Strait of Hormuz is a vital maritime choke point that handles a massive percentage of the world's liquid petroleum. Now, we want to be very clear here. We are not taking any political sides or endorsing any viewpoints regarding the geopolitics of the Middle East. We are strictly impartially reporting on the market mechanics mentioned in the analysis.
All right. Regardless of the political outcomes or the specific actors involved in any Middle East tension, global energy markets react ruthlessly to the mere probability of supply constriction.
It's all about supply and demand.
Exactly. When a maritime choke point is threatened, algorithmic trading systems and quantitative funds immediately execute sector rotation. Capital flows rapidly out of high-beta tech or consumer discretionary stocks and surges into hard assets and energy.
But the natural question is, why does that capital flow into a tiny microcap like Trio Petroleum instead of just buying Exxon or Chevron?
The answer goes right back to the onshore moat we talked about. Investors and algorithms start hunting for safe haven energy plays that are completely isolated from the geopolitical conflict.
Because Trio's assets in California and Alberta do not rely on maritime shipping through conflict zones.
Precisely. Capital looking for outsized returns rotates into small-cap onshore producers. Because if global supply drops and oil prices spike, the margins for an insulated company like Trio will turn massively, violently profitable overnight.
It's an asymmetric bet. The trader is risking the volatility of a microcap to gain leveraged exposure to rising oil prices without taking on the geopolitical risk of international supply chains.
That's the exact thesis.
But here's the craziest part to me. Despite this incredibly logical setup, and despite a 138% price surge driven by perfect macro and micro timing, the sentiment data algorithms completely missed the plot.
They really did.
The quantitative sentiment scoring from the top 5 relevant news stories about Trio Petroleum is stubbornly neutral. It literally registered a sentiment score of 0. How does a stock jump 138% and the news algorithms just shrug?
Because algorithmic sentiment analysis often struggles with the nuance of microcap financial maneuvering. The natural language processing tools are scanning millions of articles. They see the Alberta production update, they see the stock on a list of generic top daily gainers, and they see the debt conversion.
Right.
To a human analyzing the balance sheet, an institutional investor retiring $1.2 million in debt for equity at the absolute bottom of the cash runway is a massively bullish signal.
It's a huge vote of confidence.
But to an algorithm, debt conversion is often just coded as a standard neutral corporate accounting event.
So it operates like a stealth fighter on the market's radar. The company is moving incredibly fast, fundamentally changing its financial trajectory, but the traditional automated tracking systems just register a neutral blip.
Which means the broader market hasn't fully digested the momentum yet. Retail investors see the surge, they note the average trading volume of roughly 6.96 million shares, and they hesitate. They're pricing in uncertainty about whether the volume will hold or if it's just a temporary flash.
And that uncertainty perfectly sets the stage for the next 3 months. For you tracking this at home, the critical date on the Catalyst calendar is the Q1 2026 earnings report. That's expected around March 16.
And going into that report, there is notably no consensus analyst estimate.
None at all.
Wall Street analysts aren't heavily covering this stock right now, which leaves a massive information gap for retail investors willing to actually do their own analysis.
Which is exactly what we are doing today. And the ultimate synthesis of all this data results in that 7 out of 10 bullish score.
So if we had to distill the entire strategic outlook for Trio Petroleum into an elevator pitch, it looks like this. You have a company demonstrating 87% revenue growth, actively crossing the valley of death into production.
They just fortified their balance sheet by eliminating immediate debt dilution risk through institutional cluster buying.
They have brand new, stable production coming online in Alberta, bringing in daily cash flow.
And all of this positions them for a major cash flow inflection point, exactly at a moment when global geopolitics could drastically spike the value of the heavy oil they are pulling out of the ground.
And underlying all of that operational maneuvering is the ultimate safety net we keep coming back to: $475 million in proven PV10 reserves.
So the suggested strategy from the market analysis is a swing trade heading into that March 16 earnings report.
The objective is to ride the current momentum, verify if the earnings actually confirm the narrowing losses in the Alberta production numbers, and then potentially extend that trade into a multi-quarter hold as those economies of scale finally flip those negative margins into true profitability.
Navigating the mechanics of microcap energy investing really requires looking past the raw, absolute numbers. You have to analyze the percentages, the trajectories, and the human decisions driving the balance sheet.
That's right.
Seeing a negative 1,800% margin is only half the story if you don't look at the $475 million in the ground and the smart money trading their debt for a piece of the upside.
I'll leave you with a final thought to mull over as you analyze these markets on your own. When you invest in a microcap commodity stock that is heavily insulated in North America, are you actually investing in the company's internal fundamentals and operational efficiency? Or, given the immense influence of global choke points on oil prices, are you essentially buying a leveraged call option on global geopolitical instability?
That is the defining question for any energy investor right now. Keep digging into the data, keep looking at the trajectory over the absolute numbers, and always keep questioning the mechanics behind the headlines. We'll catch you on the next analysis.